Hi and welcome to my channel, and in this video I'm going to be sharing with you how to avoid overtrading as a forex trader. Now, overtrading simply is the habit of taking multiple trades at the same time as a forex trader, and this is actually a major risk which newbie traders always fall into, which eventually ends up affecting their account. So we said overtrading is a common pitfall for traders, often driven by emotional or psychological factors. For beginner traders, the urge to make big money within a short period of time leads them to take multiple trades randomly, thereby hurting their account on the long run. And in this video, I'm going to be sharing with you strategies that will help you to avoid overtrading. And the first strategy is that you need to develop and stick to a trading plan. You see, if you don't have a plan as a trader, you are setting yourself up for failure or for blowing up your account. So before you start trading, you need to define your clear rules. You need to have specific entry, exit, and risk management rules. This is very, very basic and essential if you must trade forex in the long term. And also, you need to set daily, weekly limits. Decide on the maximum number of trades you want to take per day or per week. So if you have set a limit already for yourself that maybe each day as a day trader you're not going to take more than 3 or 5 trades for the day, then don't exceed it. Even if there are more opportunities to take more trades, once you have hit that threshold, then you stop for the day. If you're a swing trader, if you've determined that you're not taking more than 3 to 5 trades per week, even if more opportunities show up, then you don't. So putting this in place will put a check on you, so that you don't go beyond your risk limits by opening multiple trades randomly. The second thing to focus on is on the quality. Focus on quality over quantity. I made a video, it's on this my YouTube channel, where I was saying that you need to determine to trade more of quality trades than quantity. The quantity is everything that comes your way, you're just placing it. Quality is when you prioritize on high probability setup. That way you are taking a setup that has a higher probability than just any random trade. So you only trade when your strategy's criteria are met. Meaning out of 10 trades, probably is only 3 that meet your criteria. That's the one you trade. See, you are a better off trader if the 3 trades that aligns with your strategy becomes a winning trade than taking 10 random trades where you are winning like a 5 or 6. No, the better you are when you trade a high probability setup than just any out trade. And also, in terms of focusing on quality over quantity, you also need to avoid impulsive trades. Resist the temptation to trade just to stay active. And this comes up often because you're always on your system, you're always on your phone, or you're always on your laptop. There's always that tendency to be impulsive with trades. You will see some trades that are not up to your trading plan, but because you feel you just must take a trade, you end up trading them. But you need to avoid taking impulsive trades as much as possible, so that you don't overtrade. The third thing you need to do is to manage your emotions. Overtrading is simply an emotional response to trading, and this emotional response means that you need to learn to control your greed and fear. Under trading psychology, rather, the key things there is about greed and fear, and that's the major emotions you exhibit as a forex trader. So you need to control your greed and your fear. It is greed. See, when you see over trading, it's nothing but greed. The greed that I want to turn my $1,000 to $2,000 within the next 1 week. So you think it's by taking plenty trades that will become a reality. What if all those trades turn to losing trade, or what if 50% or 70% of it turn to losing trade? You lose your account in the process. So you need to recognize when your emotions are influencing your decisions. As a trader, your emotions is not meant to rule you. You are the one to put your emotions under check. So make sure to control greed and fear. And another way to manage your emotions is to take breaks. Stay away from the screen after a string of trades or losses, a string of winning trades or losses. We don't learn to do this. Once you are on the system, you're on the phone, you've had a couple of winning trades, you want to stick because you expect the market to keep going that way. So you want to stick up with your system or your phone, placing more trades, looking for opportunities to place more trades. But the best you can do is that after a set of winning trades, or even sometimes losing trades, learn to take a break. Sometimes you may need to set a timer for yourself to take a break. Just take a break and leave your phone, leave your laptop, and go and do other things. This will help you to manage your emotion while trading. The next thing we need to note in terms of managing overtrading is that you need to limit market exposure. Set a daily loss limit. Stop trading for the day if you reach your predetermined loss threshold. You see, there is a maximum amount of risk you can take per trade on your account. Professionally, you are not expected to risk more than 2% of your account per trade. So you may set a daily loss limit. Maybe if you hit the 2% 3 times, that's your maximum risk you're willing to take for the trade, then stop trading for the day. Don't wait until you lose 30% of your account in one day. It's not, some people do it. They keep taking a trade, then they want to take a revenge on the market. They keep coming back, doing the same thing. See, when you keep doing the same thing over and over again, you're not learning. So when you hit a certain threshold of loss, which you have predetermined, then take yourself off the system for that day. That's enough. You continue next day. You see, I always tell my students that there will always be another trade another day. So don't trade as if the only trading opportunity you have is only today. No, tomorrow there will be another opportunity. The market is not going anywhere. So learn to set a daily loss limit and also avoid over leveraging. Keep your position sizes appropriate for your account size. And I cannot but emphasize on this. Stop over leveraging your account. There's a recommended leverage that your account can carry. Maybe a ratio 1 to 500, a ratio 1 to 400. It's okay. A high leverage, definitely a high leverage will give you opportunity to make more profit. But you see, it's like a double-edged sword. If the market goes against you, your loss will equally be large. So what do you want? Except you're willing to take risks. As okay, if I'm willing to lose my account, I don't mind. But that's not a good way to trade. I believe you should be trading for the long term, not just for the now, So make sure your leverage is in the line with your account balance. That will also help in keeping your account very safe. Number 5 is that you need to maintain discipline. Follow your strategy. You see, one of the biggest problems Forex traders have is in maintaining discipline. I'm telling you, it's one of the biggest problem with traders. You need to avoid deviating from your plan under pressure. Regardless of what you're seeing in the market, always stick with your trading plan. That is what is called discipline. Don't go with just every move you see. What is your trading plan? Stick with the discipline of staying with your strategy, regardless of what you're seeing in the market. And one of the ways to really stick with discipline is to use a trading journal. Record all trades, including the reasons behind them, to spot patterns of overtrading. I tell you, a trading journal will deliver you from a lot of headache when it comes to trading. It will help you to track your trades that are consistently successful, why they are successful, and the ones where you are having losses. You will also be able to track what you are doing wrong that is making you to have a loss. So always use a journal, to maintain discipline as a Forex trader. Number 6, you need to understand the market. See, this one is very important, and please listen clear. Avoid choppy markets. Stay out when there's no clear trend or signal. Most of the money in Forex trading is made when the market is trending. Either it's trending up or trending down, and majority of the losses are made when the market is choppy or ranging. When the market is choppy or ranging, there is no clear direction. So you have to learn to identify times when the market is in a range, and the best thing you can do at that time is you need to stay out. Some people have this mentality about trading that anytime you enter into the market, you must be able to pick a trade. There's nothing like that. If that's the way it works, then everybody trading will have been a billionaire by now. You have to learn. One of the ways to stay safe is to stay out. 3 things we do in trading: we buy, we sell, or we wait. So the waiting period is the time you are waiting for the market to clear out any choppy, situation, any ranging effect, until there is clarity and direction in the market. Next, you need to know when not to trade. Recognize low probability times, such as during major news events, if you lack a specific news trading strategy. Now, this is very important. If you lack a specific news trading strategy, then the best you can do is, when it's time for a news, stay out. I'm telling you, if you are not sure of a strategy to trade news, then stay out. But then if you follow my mentorship, I can train you on how to trade news professionally, efficiently, effectively, and profitably. If you look through my list of videos, you see some videos on the news trading I've done and the amazing results that came out of it. And you can reach me for mentorship on how to train you on how to trade news professionally. And at this point, if you're enjoying this video, please go ahead, click the like button, share this video, subscribe to this channel, and drop comments in the comment section. Let's continue. Number 7 is that you need to set realistic expectations. This is very important. Most people that come into forex trading, they have unrealistic expectations. Some people, the mindset they had when they were starting out is that, oh, I want to start with $500 and I want to be cashing out like $3,000 or $5,000 every month. It doesn't work like that. It does not work like that. You need to focus on consistency in setting realistic expectations. The goal is consistency. Understand that every day will not be profitable day, and that is the simple, honest truth. I've come to realize in forex trading, many new traders like someone that will lie to them. Yeah, many people, they like to be lied to. They like somebody that will tell them that, oh, every single day you'll be making 5% of your account. If anybody ever tells you that, that's a lie. I can tell you that authoritatively. That's a lie. The market doesn't work that way. There are days when the market is down. There are times when everywhere is red. It happens. And it is your discipline, your risk management that will save you in such a time as that. So the goal should be more of consistency. How many percentage of your account can you do in a month? Can you do 10% in a month? Then do that consistently. Now, if you are consistent with a kind of result like that, with a conservative result, then over time you will build your account. See, someone that is consistent with a 10%, 15% every month is better than another person that does 30% this month, 5% next month, 11% the third month, and 25%. No. You need to be consistent. Have a consistent result. That way, you are setting realistic expectations from the market and avoid unrealistic goals. Aiming for constant action or massive returns can lead to overtrading, and that's just the truth. If you're already aiming at buying let me not say it, with just your account of $1,000, please set very, very realistic goals. Don't set unrealistic goals so that you don't push yourself into overtrading and hurting your account in the process. Number 8, use automation if appropriate. Now, if you have opportunity to go the automated way, to use automation, don't stop it. Don't shy away from it. Set alert tools. Use tools to notify yourself of trade setups instead of watching charts constantly. To be honest, watching charts constantly can be boring sometimes. It can be boring. So if you can use automation to set alerts so that you don't need to watch the chart at all times. Maybe you already set an alert that if price gets to a certain level, then you know that at that level your strategy should have triggered into a tradable setup. Then the alert will notify you instead of just staring at the chart, waiting for hours on end until price gets to that particular level. Also, you can automate your strategies. There is complete automation in trading and there is semi-automation. So you can automate your strategies. Consider using algorithms for precise execution and to reduce emotional involvement. And that's all in this video, where I've shared with you 8 points on how to overtrade, on how to avoid overtrading as a forex trader. If you did enjoy this video, if you got value, please click the like button, smash the subscribe button right now, subscribe to this channel, and click on the notification bell so that you can be notified whenever I drop a new content like this. And most importantly, also go to the comment section and drop a comment. And if you want mentorship in forex trading, you are completely new, you're a beginner, you don't know where to start from, yet you understand the financial independence that this industry can give you, then I can mentor you. I'm a mentor in this industry, years of experience, and a trader also. Then go ahead now, you see a link around this video or somewhere on this channel. Just click on it to take you to my WhatsApp, where you can let me know about your intention to be mentored as a forex trader. All right, I'll see you in the next video. Take care, and it's bye for now.